Hello and welcome to Steps to Investing on YouTube. Today we're talking about investment accessibility, and joining me in the studio to talk about that is Adam Piplica. Adam, welcome to the show.
Thank you for having me.
You're welcome. Perhaps if I could start by asking you to introduce yourself, tell us what you do.
Yeah, so I'm Adam Piplica and I work in financial planning, and I'm also a blogger, so that's how I ended up getting started in it. I started just being interested in investing when I had no money at all, when I was a student, and I had to receive information from investment companies and get them all delivered, and they all came in the beautiful prospectuses, filled my post box, and I looked through all the information and started making sense of it when I was a student.
Wow.
Fantasizing about investing for when I actually did have some money.
Right.
And I got started, and then I tried to encourage my friends to learn how to invest and teach them and encourage them, because I found it such an interesting topic. So I started working in an unrelated field and started writing about it in my spare time online at my blog, Magical Penny. And it grew, and I had people asking me questions, and I kept on saying, well, I'm not a financial advisor, and this isn't financial advice, but this is my experience, and these are the things to look out for. And eventually I decided, why don't I actually work in financial planning and help people be able to take people to the next level? And so that's how I got into investing.
And what's financial planning about, really? How does that work?
Financial planning is helping people work out how much money they want for their goals, helping them work out what their goals actually are. Can they afford to invest? Can they afford to go on all the holidays they want? Can they just basically live their life in the way that they want, and how money facilitates that? So it's kind of a holistic look at how to make people be able to live their dreams, as cheesy as that sounds.
Okay, so today we're talking about investment accessibility and access to information, I guess. You talked about those prospectuses arriving on your doormat. They're not for the faint-hearted, really, those documents. That said, do you think it's easier to get hold of information about investing than before?
Well, when I was starting to find information, this is about 11, 12 years ago, and there was a thriving online scene, but it was very American focused. There was lots of Americans who were very engaged with investing in a way that I didn't think British people were. I tell my friends, I think if the iPhone was invented by people in the UK, we wouldn't necessarily have a stocks icon on the homepage. That's a very American thing. I think Americans are more engaged with investing and financial process. So when I started learning to invest, I knew a lot of the American terminology and not so much the British one. As an example, I went to find an index fund, which is a fund that just buys across an index, a list of different companies. And they're really good ways to get started often, because you're getting a broad spread, and we talk a lot about diversification when it comes to investing.
Yeah.
And I went to search index fund. I like to buy an index fund, and I couldn't find it. It didn't actually come up on my searches. And it's because in the UK at the time, I think it's changed a little bit now, but the word tracker fund was a lot more common.
Right.
And for someone who was completely new to investing, just not knowing the difference between index fund and a tracker fund, and is that the same, meant that I couldn't find the information I needed. I think in the last 10 years, it is more accessible now, particularly as people can now invest from their smartphone.
And in terms of doing that, in terms of accessing your investments, I mean, obviously you invest for yourself, are you a frequent checker of your investments?
Depends how they're doing, really. I think there's a lot of human psychology when it comes to investing and knowing yourself. So when I first started, I was checking every day because it was fun looking at the numbers going up and down. And this was actually just at the very start of the financial crisis.
I was going to say 10 years ago, it must have been an interesting time.
Exactly. So I started in 2007, and I remember I put a post up on Facebook telling my friends, like, I've been investing a week and I'm up £20, and that was exciting to me. And then it just went down,
down.
But I'd already done a lot of preparation with the reading and learning, and I was at the start, so I didn't really have that much for it to go down. And I knew that I was in my buying phase, so essentially I'm getting things on sale. But that's the counterintuitive thing. We always want things, when we're going shopping, we want prices to go down. But when we're investing, we do actually want prices to go down at the start, at least, because that's when you're buying. But it doesn't feel right. Yeah. So you have to kind of get used to it. So I did stop checking, and I like to check about once a month. just to see where I'm at. But I don't take action on that. If it's gone down, I tell myself, well, I'm still in a buying phase. When I'm looking at things, oh, how's it done over the last year or last 3 years, then I'm taking a longer term view. But I try to not look at it more than once a month. I don't think there's any need to look at it any more than that.
You picked up on a couple of points there that are really interesting. I think one is around the time frame for investing, and you're holding your nerve in those kind of early days. Did you, when you started out, have that time frame in mind? This was going to be a long-term endeavour?
Yes. One thing I think is a bit annoying when you're looking at research and looking at information with investing is everyone says, what's your timeline? What's your plan? And I was like, I don't really know. What do you mean a plan? A huge pile of money, please. That's what I'm hoping for at some point. I didn't have I need £10,000, £20,000 for a house deposit, or I didn't know what my plan was, so I found it quite annoying when people were saying, "Oh, invest to a plan," when I didn't know what my plan was.
I see.
I did know that I did have a long time horizon. I wasn't investing any money that I needed over the next few years. I just wanted to help my future self. I use the idea of being a best friend to my future self a lot in my writing, because I want to do a good job for when I'm much older.
And just to also pick up on the comment you made about telling your friends about investing and trying to get them to do it. What was their reaction? The reason I ask that is often in financial services you talk to people and ask them about their friendship group and whether they invest, and they say, well, no, they don't really understand what I do. They think I'm an accountant. It's kind of over there. It's not something that's commonly understood. Did you find that with your friends?
Yes, and I felt like it was this black box essentially. That's what made it kind of interesting to me at the start, because my parents didn't have a background in investing. They were members of pension funds, and these pension funds, they didn't know what these pension funds were. They didn't know what the investments were, what was inside these pensions that were going to provide an income when they eventually stopped working. And it seemed closed off. And I didn't even consider financial services as a career option. I didn't even have that in my sphere of influence, even though I was interested in the topic. I never even thought, oh, that's something for me. So I was more tentative in terms of researching. And then when I found that it wasn't as complicated as some people thought it was, and it was for everyone, investing is for everyone. It's not just for the super rich. It's not just for people who have the right connections. And I knew it was an exciting time because I felt like online information at the start, even if you couldn't invest easily, the fact that you could find out information online, this great democratization of information that the internet was providing, that was what was really exciting. And I thought, I'll start with my friends, and there's only so much you can talk to your friends about investing before
the glaze over.
Before the glaze over, even though they shouldn't. And so I started writing a blog which was open to everyone, and then I had people from across the country and then across the world reading what I wanted to say, and I got to learn different things. And it was really, really exciting. And also, you find that there are actually friends who are interested, but they might not say it out loud or publicly. And I might have written something, and then a few months later, a friend would come up to me and, you know what, that was actually interesting, and that made me want to look into it further. And I've opened up a stocks and shares ISA now, and
wow.
That made me feel really good.
Yeah. So in terms of those changes we've been talking about, where information has become more accessible, more easy to understand, do you think that has reduced risk when it comes to investing?
In a way, no, because as things become more accessible, you can check on them more easily. Like, my parents had a pension, they didn't understand it. When the markets were going down, they weren't going to mess about with it because they didn't even know about it. They didn't know that on paper they've lost tens of thousands of pounds in a market correction. And I think with accessibility, it does become a responsibility on yourself to keep calm when markets don't always go up all the time. Over the long term, they tend to go up, and history has taught us that in markets do go up over the long term, and people do generally well, and it outpaces inflation and things. But there are periods of time, and it can be relatively long periods of time, where there's no progress made at all, or it can go down. And having accessibility to your investments and knowing that can be quite dangerous, which can actually make things more risky, because then you might say, no, this isn't for me, and pull out.
Okay. And in terms of when you're researching an investment for yourself or for somebody you're helping, What sort of time frame does that take? Is it, do you find it's got quicker with experience, or is it something that where you watch something for a period of time before you invest in it? How does that work?
When I'm talking with people about investing, the first thing I talk about is not investing money when you might need it in the next, I say 5 years. You need to think you don't need it until you stop having an income, essentially. That's the safest view, really. Yeah. There's a temptation to think, well, if I'll just put money in now and see how it does in 2 years, and then I'll take it out. And I tell people, try to have a longer time period for that. And because you don't know what might happen, you can be really diversified and be a globally diversified, have investments across the world, and the whole world could not make progress for a certain amount of time. And if you need that money, then you're going to take it out and it might be worth less than you've put back in. And a lot of people can't handle that. I also think that people don't really know what their attitude to risk is until they've actually lived it.
Right, okay.
Because it's easy enough when there's questionnaires that say, imagine that you lose 20%. How would you feel? Would you hold your nerve? And you might think, yeah, I could cope with that, 20%, and it's for the long term. And then when you actually see it and you log in, it's so different when it's your real money, even different to just having play money.
Yeah.
So often people's time horizons and amount of risk they're willing to take changes as they experience it.
What about successes there? You must have had some success in your time in this.
Well, I started investing at what could be considered a bad time, the start of the recession, but I did invest in across the world, and I remember investing in some equities that were emerging markets that did quite well, and like Brazil and in India, they've both had a lot of growth. And just by being invested, I've seen a lot of the growth of the world economy over that time.
Yeah.
And I've also invested in cryptocurrency, which isn't necessarily investing, it's more speculating. But it's that I invested in 2013, back when cryptocurrency was relatively unknown and quite difficult to actually get into. And I bought a few Bitcoin and a few other cryptocurrencies, and that did very well. And it was quite surreal seeing it double and triple over the course of a few weeks. But that's also been where my investment losses have been the most as well, because the cryptocurrency space has suffered a huge falls. It's very volatile. It can go up and down very quickly. And I'd say that's probably the best and the worst investment.
Okay. Well, let's sum up then. In terms of accessing information on investments, what would your top tips be for somebody just starting out?
The financial blogosphere has exploded in recent years, and there's a lot more English and UK voices than there was at the time when I first started, when it was dominated by American bloggers. So I think that's a really good place to start. And I also think that the actual fund providers and the investment managers, they're making things more accessible than ever before, because it's in their interest too, because they want to share information, and it's more easy than ever. They don't necessarily have to send those bulky prospectuses in the post.
Okay, that's super. It's been fascinating to hear your experience. Thank you very much for sharing that with us.
Well, thank you for having me.
You're welcome. And thank you for watching. That's all we have time for in this week's show. We'll see you again next time. Goodbye.